Ladies and gentlemen, this is Christopher Aaron. Thank you for tuning in. It's July 18th, 2018. We are looking at a significant break in a support level that we've been watching for the price of gold. Let's look at some ramifications on the charts, and also let's talk about what some of the things are that we can do to protect ourselves as precious metals investors. I have been through several of these cycles before in the past, these ups and downs with precious metals. There is a game plan. There are some things you can do to lessen the impact if the markets are not going to move in our direction for the foreseeable future. Let us look. Gold and silver over the past 3 days, and we've been talking about over the last week or two that the support was being tested. It kept bouncing. Well, we were not seeing any strong down days, noticing the lack of the sell stop flushing thus far until when? Yesterday. So Tuesday finally gave us that day where that support level we were looking at, 1240 to 1245, clearly broken. Fairly high volume, sort of waterfall capitulation type of day over the short run, and some follow through selling today, and basically a negligible recovery, nothing even to mention yet. So this was the break that we were talking about, that we were saying there was a possibility this market could morph into a negative pattern. That is what we're seeing over the short run. We look at silver, similar follow-through action. We will not be getting into the silver chart right now. That will be in the premium service coming up this weekend. But suffice it to say, silver is also facing an absolutely critical trend test at the present moment. It is wavering right on the edge. Now, why am I even here? Why am I producing this content? I told you I've been through several of these cycles before in the precious metals, and there was something that I felt that I had to share, I had to offer, and I just want to give you a little quick lesson from my own investment career going back to the previous decade. And I first became interested in the financial system and studying economics and investing in the early 2000s, and did some dabbling in various markets and various stocks for the first few years. And then I quickly began to learn about the precious metals, the Federal Reserve, the theft that is taking place in front of our eyes by the banking system, all the fundamentals that we know. For me, that began to happen in the mid-2000s. And I think I began to buy my first gold in the middle part of 2007, gold, silver, some of the mining stocks. It's when I became interested. And I experienced this first run-up in the price of gold to just about $1,000 per ounce in 2008. And I remember specifically investing some very big chunks here in the middle of 2008 when gold had already come back from 1,000 back down to 860. And I was thinking, this is great. It's pulled back. It's giving me a time to average in here. It's down 14% from the high. This is good. We can average in. And we started to see this rounding up toward 1,000. And I thought, yes, this was great. I timed it well. I did most excellent. And then I remember as 2008 was developing and the crash in the housing market and the subprime market was developing, I remember certain technical analysts were saying something in this time period in July, getting into August of 2008. And they were saying, guys, something is wrong here with the gold market. Despite what those fundamental type analysts were talking about, something was wrong in the gold market when we began to see this breakdown from a significant trend line representing the final part of the advance in 2007. They were saying you want to become defensive, you want to be careful here because we don't know what this can morph into. And sure enough, when we saw this breakdown here below the trend line in 2008, the result basically in 3 months, I mean, imagine this, 3 months, gold moved from just under 1,000 down to 680 per ounce. Over a 30% drop in 3 months. You know, this would be like gold moving from 1,300 down to below 1,000 in 3 months. So can you imagine the kind of pain? And all the while, we had these fundamental investors, many of them very famous, who were coming on the air and saying, The problem is with the banking system. The problem is with the Federal Reserve. Therefore, buy gold. And they were completely blindsided by the downturn that we saw in 2008. All the well-meaning individuals simply failed to recognize that gold could fall simultaneously. And the only way that we would see that is from a study of when trends are broken and when they are maintained. We can look at the silver market. You want to call that dramatic. Look at the silver market in 2008. A 5-month channel here forming, clear breakdown here in early August. 3-month decline, 60% in 3 months. So if you think it's intense watching silver fall from 17 to 15 and change, we're talking a 10% move in a couple months. Imagine a 60% move in 3 months lower. Someone who was investing in the sector at this time, and I was, basically the strategy was to close your eyes and wish and hope that this was an entire just bad dream and that you would wake up and this wouldn't have happened. When you're down 50, 60% on your investment that you believe in fundamentally, because you know all these things are going on in the background with the Federal Reserve and the currency and the fiat currency, but the market moves against you this strongly, basically there's nothing left. You just have to step back and say, well, I have no idea what's happening here. And a lot of people did that, and a lot of people wrote it out, but a lot of people sold at the bottom. We can look at the mining sector. You want to talk even more dramatic, what happened in 2008. I'm just explaining this is the time period that I really cut my teeth on. I drank from the fire hose. It was an initiation by fire here in the gold market for me in 2007 and coming into 2008. So the mining sector fell in 3 months 70%. Some of these companies have fallen 10 or 20% over the last few weeks. Some are down a bit more than that over the last year or so. But imagine you're investing here in 2007, 2008, and the sector falls out from underneath you 70% in 3 months. You basically think you're on another planet. You're in the twilight zone. Nothing makes sense anymore. The world is turned on its head. This brings us to the present. These are the lessons that I learned in the past decade. I listened to both the fundamentalists who sounded like they knew what they were talking about on paper, but then the market moved completely opposite them in 2008 and again in 2011. And so here we are, and I dedicated myself to studying technicals over the last decade, various forms, work better than others. And there's a form that I've gravitated to here where we're looking at the gold market, what was a rising support line with flat resistance, and we are seeing that broken in no uncertain terms. So what happens? We looked at those examples from 2008. We've looked at examples from the past. What happens when an important trend line is broken? Of course, we have basically a do not pass zone that has now been established here in this 1365 to 1378 region. This level corresponding with all-time high volume, this level will not be overcome anytime soon in the gold market. We have a do not pass. We have a broken support region here. Where does that leave us in the gold market with basically a price trajectory such as follows in green? This is not meant for short-term trading. You can see that there's a wide range that this market can move in according to our expectations. But the one thing that cannot happen in this market is basically it will not recover the broken trend line in a highest probability scenario. Now, there can always be outlying events. There can be black swan events that no one can predict. There can be occasional false moves downward that occur in any form of analysis. But in a highest probability expectation, we expect that gold will move at best sideways, perhaps marginally higher in a bit of a recovery, and then begin to fail again later on this year into 2019, coming back into the low 1200s, the 1100s, or perhaps even back down to retest the 2015 lows. This is the logical outcome of a failed advance. This is an advance that the gold market was trying to break out of this resistance zone. It failed to do that, and we're now in a different scenario than we were just this time a week ago. Now, there are some support levels we would be looking in here in gold over the next several months to perhaps 6 to 12 months, and we'll be looking for the potentials for support to emerge here. For example, at the major support level here back from 2016, 1122, the bottom zone here in December 2015 down at 1045. And I'll tell you this, if we are going to get another surge like this in 2016, perhaps in 2019, perhaps late 2019, perhaps it extends out, the only way that you will know that this is going to set up, go and watch the archives from this channel, please. And notice that we were talking about the potential for this setup back in August, September, October of 2015. And we caught that one really well. And this market hasn't worked in our favor since then. I'm saying the only way to know when we are approaching an important potential here is to study these support and resistance levels. We can see these light dashed black lines here. We can see corresponding with these swing lows back from 2017. There's a chance that gold may bottom here in one of these swing lows. I would say but a higher probability that any bottom there will be a failed recovery, and we will see lower prices later on this year into 2019. We will be looking for the next major bottoming attempt to form somewhere in this lower part of the green shaded region. It is not wise to tune out the markets if you hope to participate in these markets in a later cycle. The time to follow this is now, getting ready now so that we can participate when this next major surge happens. We will talk about some defensive postures that you could take here as we move forward. Gold is not going to be breaking its 2016 high this year. There is a different trajectory that is setting up. It's one of either range-bound or lower prices. Short-term traders will have to dial this analysis in much closer, of course, which we will do from time to time. Let's talk about this. What can you do to protect yourself? Let's say the gold price is going to drop another $200. Let's say it's going to fall back to $1,000 or back to $1,100. What are some things you can do? Let's talk about a few ideas. No one idea will apply to everyone, but here are some ideas that you can consider. First of all, is this going to be a false breakdown? Will we see a recovery of that trend line here over the next couple of days and just totally negate that? Maybe it just flushed out a bunch of traders over the short run. This is possible. It's rare. It does happen occasionally, but it's rare. That's what I would say. So we can look out for this. We will keep following this to see, does this market reverse on us suddenly? If so, I have no problem getting back invested once again. But this is a rare possibility should this happen. What else? We want to wait for the next primary downtrend to be broken to make large purchases. Whether that's in the physical metals, gold and silver, or whether that's in the mining sector, there will be a new primary downtrend that forms. We will not know this right away. We will develop this trend as it is shown on the charts over the next several weeks and several months, and we will wait for this primary downtrend to be broken for the potential to make next rounds of large purchases. This will not be random when we choose to do that. Some other possibilities, you could choose to initiate some short or inverse ETFs. We're talking about paper gold. We're talking about the ETFs, exchange-traded funds that trade on the stock market. These allow you to profit if the metals prices fall. Advanced traders can use put options or shorting futures contracts outright. But for the general investor, you'd be looking at short or inverse ETFs. Please beware of the leveraged ETFs. My sense is that any decline that's coming in the price of gold over the next 6 to 12 months is going to be quite choppy. And what happens with these leveraged ETFs is they will actually decay from a choppy market. So these can actually lose value even though you're right on the direction. If you're correct that the gold price falls, the leverage ETFs can actually lose value even with a correct assessment of the price. Please be careful of these. I say stick with the unleveraged ones, especially if we're talking about a longer move here. These are the ones you may want to consider: shorting the GLD, shorting the SLV outright, and the DGZ fund, ticker DGZ, is an inverse GLD fund. So you don't actually have to initiate the short. Some people are more comfortable just buying an inverse fund. Keep in mind, we're talking about protection in the paper markets if people want to try to offset their losses, which may be amounting in the physical metals over the next 6 to 12 to 18 months. And I would not recommend initiating these just randomly. I would recommend paying attention very closely to the charts and initiating these when we get the next potential bounce. If that bounce looks to be a failed rally, that is the time to initiate these, not after a strong drop like we have just seen. Let's talk about a couple other things here. Are you leveraged? Are you heavily into the mining sector? You may want to consider trimming certain positions or more aggressive defensive action. This is what we're going to be getting into in the premium service this weekend, laying out some concrete plans here that various people can consider depending on how leveraged you are, depending on the position that you're in. What is the point here? Ultimately, we want to survive to see another day. In my career in the past, I have had significant gains and I have had some losses. And I know how all these cycles feel. And if you simply see what we're going through right now as another cycle, and that your job in a declining market is to survive, to see another cycle, another day when this market begins to rise again, your job is to make it through to that point and to be prepared, then it's not so bad. There are things to keep our eyes on and to learn and to study as we go along. Please, I encourage you to try to do this. So in closing, I would just say, if you're feeling emotional at this point, if you're having a hard time falling asleep, just imagine what individuals like myself and a lot of other well-meaning investors were looking at in 2008 when the mining sector fell by 70% in 3 months, right? Not 10 or 15% over a year like we've seen, but 70% in 3 months. Imagine what we were going through and the things that we learned, which is to be very, very careful of these fundamental stories that don't always play out. And I would just encourage you, if you're feeling anything like this or anything else emotionally, here's a question. Are you overinvested? Do you have too much of your free capital at stake? And is it clouding your judgment? If so, this is the lesson to learn. This is the time period to learn that. There is something to be said for only investing up to a sleepable amount, an amount that allows you to rest soundly at night no matter what happens with the markets, and to enjoy the other facets of life and of beauty that are still around us, because there are plenty of them. There is a premium service that I offer for subscribers. We cover the latest trajectories in gold, silver, the mining sector, the US dollar, the stock market, the bond market, the commodity index, and the individual companies that we are investing in here, as well as all the research to back this up. I do work one-on-one with investors. We will be considering these protection considerations, as I've mentioned here, in more concrete detail in this weekend's update. Various possibilities to consider, and what we do is we publish in real time the exact moves that we are making here, so that if you would like to follow our moves, you can do that. I work with individuals. If you would like to speak one-on-one with me or by email, we do that also. There's an email option if you just have a quicker question. You can find more about that on the website on the consultations tab. I do thank you for tuning in. It's a challenging time in the markets, but I would just say this. It's never easy to get involved in a bottom process. I'm convinced that what's setting up in the metals and in the hard assets is a bottom. It's a long-term bottom that is being put into place. It's just not taking the more aggressive route higher that we wished that it would. Markets don't always follow our wishes. That doesn't mean to throw everything out the window. That doesn't mean to abandon it. That doesn't mean to sell everything that you have. It simply means we have to be realistic about this and unemotional. So if we stay unemotional, we will think clearly about what is setting up here. We will pay attention to the important support and resistance levels, and we will not make any rash decisions. So that is the point of this channel and this service, and I do thank you for being here with me this evening. The next update will be a week from today.